So she's 55. She's got several years, for this IRA to continue to compound tax deferred, or does it make sense to slowly chip away at this thing and pay a little bit of tax to really blow up the Roth? We got Susan from Atlanta writes in, Dear Big Al, Joe, and Andy, I'm wondering how much should be done to strategize for future tax increases. I'm currently filing head of household and fall into that 12% tax bracket. I've been making small Roth conversions while staying in the 12% rate. Rates are going back up in 2025. I'll probably lose head of household status around that same time, pushing me firmly into the 22% or future 25% tax bracket. Does it make sense to convert an additional $35,000 now and fill up that 22% tax bracket? I'd mostly like to make some sales in my brokerage account to pay the extra tax. I'm 55, y'all, and currently have $365,000 in a brokerage account, $450,000 in a traditional IRA, $400,000 in a Roth. I'm also expecting to inherit some taxable and tax-deferred funds at some point, which could possibly push me into higher brackets with the expected dividends in the required 10-year drawdown. Thanks. Susan. All right. From Hotlanta. I would go to the 22. What the hell?
Probably 20. I mean, you're going to be in the 22 anyway, which is going to be 25. So I would just plan ahead for that. You've got a good chunk of money in the traditional. You'd like to get more in the Roth. Sure. Why not?
Yeah. Markets are low. Convert to the 22. Now's a really good time to do that. Yeah. I like how she's strategizing though, right? Because she's got a plan. She's looking at future tax rates. She's, there's some guesstimation. There's a little bit of forecasting involved here.
And there's unknowns because we don't really know what the future tax rates are going to be.
But she's taking some of the uncertainty off the table.
Right.
Which
she's taking what she knows.
Exactly.
Which is all you can do.
Right. Here's what you know, and then you make action or decisions based on that.
And then you adjust later if need be.
Absolutely. So this is what people should be doing, taking lessons here from Susan from Atlanta. Is that it's like, okay, well, here's the tax bracket that I'm in, and I'm going to look out, and it's like, oops, okay, well, the tax brackets are going to change on me, and then I'm probably going to be in this bracket at that point. Oh, and guess what? I'm probably going to inherit a couple of bucks from mom and dad. That's also going to add to my income. Oh, and there's going to be some other stuff here. So as I'm still strategizing at 52, 50, how old was she?
She is, yeah.
I thought she said something. Maybe she didn't.
55.
55, yeah. So she's 55. She's got several years, for this IRA to continue to compound tax deferred, or does it make sense to slowly chip away at this thing and pay a little bit of tax to really blow up the Roth? And I think she's doing the right thing. It's like, okay, well, here I'm forecasting a little bit. Hey, do I go on the 22% tax bracket? You're going to pay that rate regardless. You could stay in the 12 now, or you could pay 22% to get more money into the Roth at lower at lower market values. I mean, I think it's a great strategy, and I would be all over it.
Yeah, I agree. And even the 24% bracket for actually both single and head of household is up to 170,000. So there's a lot of room even in that bracket. But of course, then you got to figure out the tax that you got to pay. You'd have to use some of the money in your brokerage account. Do you want to do that? Maybe not. But yeah, I think I would definitely probably at least convert in the 22% bracket. And that gets you up to about, let's see, head of household, 89,000, which actually the same for single versus and head of household in that bracket, 89,000 taxable income. So that might be a good target to convert to.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.